Hey everyone, and welcome to this video where we're going to learn what the net present value is. So what is the NPV? Well, in essence, it is just an investment appraisal tool. It's a tool that helps us appraise investment, so it helps us evaluate investments and ultimately decide whether or not we should invest in a given project. So it helps users ascertain whether or not an investment is worth pursuing. Remember that when we're investing in something, we're doing it for the long haul, for the long term. But given that we're dealing with the future, we're dealing with uncertainty. And the NPV helps us decrease that uncertainty to some extent, because it shows you how much money you can expect to make or lose by investing in a given project after incorporating significant risks, including the market risk, firm-specific risk, and the time value of money. So if we just turn back to the previous slide, it shows us how much money you can expect to make or lose. Now, of course, if we expect to lose money, the rational thing, i.e. the sensible thing, is to not invest in that specific project. And therefore, if we expect to lose money in a given project, we will not invest in that project. We will reject the project. If, however, we expect to make money, then it's something worth pursuing. Crucially, though, we incorporate all of these risks into the appraisal of the given investment. Now, we've talked about what the market risk is and what the firm-specific risk is in another video, so I'm going to assume that you're quite familiar with that. If you're not, I would strongly recommend you have a look at that, because we talk in great detail as to what exactly constitutes market risk and what exactly we mean by firm-specific risk. Now, in terms of the focus of the NPV, crucially, its focus is on the cash flows of a given project rather than the profit. And that's a very important distinction, because profit is not the same as cash flows. And in finance, we care more about cash flows than we do profit, but in some situations, in some tools, we do look at profit in itself. But ultimately, when we're looking to invest money, we're not really investing profit, we're investing actual cash, and therefore the focus should ideally always be on cash flows. So the NPV is great because it focuses on the cash flows of a given project. So now that we've gained a bit of an understanding of what the NPV is, let's look at how we go about calculating it. So in its simplest form, the NPV is simply the present value minus the investment, i.e. PV minus I. You'll find that some textbooks and even some academics suggest that the NPV is the sum of all the present values. And while that is mathematically true, it is mathematically correct, the logic is not as strong as this version, which is to say that the NPV is equal to the PV minus I. So what do we mean by PV and what do we mean by I? Well, the PV is the present value of future cash flows that we expect to earn. It's taken the cash flows that we expect to earn in the future and discounted them all the way back to the present so that we can see how much those cash flows are worth to us right here, right now, today. And the I, of course, refers to the investment that we intend to make in order to earn those future cash flows. So remember, you've got to spend money to make money, or you've got to invest money in order to make money. So we're investing that money today with the expectation of earning those future cash flows. And then we discount the future cash flows to get to the present value. So in essence, the PV is your earning in terms of in cash flow terms, and the I is what you're spending or investing. So I is the money that's going out, and PV is the money that's coming in. So when we say NPV is equal to PV minus I, really we're saying, well, we're taking the value of the future cash flows expressed in today's terms and subtracting the initial investment to get the present value net of the investment. Okay, so the PV, which is the value of the future cash flows expressed in today's terms, is the amount of money that you're earning or expect to earn in today's terms. And the I is the amount that you're investing in today's terms. So if you subtract the investment from the PV, then you end up with a net present value, or the NPV, which is the present value net of the investment. So of course, if the amount that you're earning is greater than the amount that you're investing, then you're making money. And if the amount that you're earning is lesser than the amount that you've invested, then sure enough, you're losing money. More on that in a bit. But the NPV in its numerical sense can only take three forms. It can either be positive, negative, or zero. Can't be anything else. But that's with most numbers anyway. So what do we mean by a positive NPV or a negative NPV or a zero NPV? Well, if the NPV is positive, it means that the investment will earn money in real terms and is therefore worth pursuing. So we should generally accept projects that yield a positive net present value. Because like we said, if the NPV is positive, it means that the amount of money that you're earning is greater than the amount of money you're investing, and therefore you're making money. So if you have a project that yields a positive NPV, that means that you're making money or you're earning money in real terms, and therefore you should accept that project. If, however, you have a project with a negative NPV, then it means that you're going to be losing money. It means that by investing in that project, you're almost guaranteed to lose money, and therefore it's not worth pursuing. So why would a project have a negative NPV? Well, if we just turn back to the equation, we said the NPV is equal to PV minus I. The only way this will be negative is if the investment amount is greater than the PV, or the present value. And if the investment amount is greater than the present value, and that means that you're investing more than you're actually earning, and therefore you're losing money. So the amount of money that you're earning is lesser than the amount that you've actually invested. And we wouldn't want to lose money, and therefore you should reject that project. Finally, let's look at what a zero NPV means. So if you have a project with a zero NPV, it implies that the project neither loses money nor gains money. And from a real-world standpoint, we would tend to reject such projects because it's not worth pursuing something. It's not worth investing in a project in which you neither make money nor lose money. That's basically the same as you not investing the money to begin with. That's the same as you just leaving the money in the bank account, more or less. So generally, from a real-world standpoint, we wouldn't accept a project if it yields a zero NPV. However, from an academic standpoint, we do tend to accept these projects too, although it is a bit of a grey area. So importantly, zero NPV projects are accepted academically, or tend to be accepted academically, but are not accepted in practice. So let's just look at those rules again. The NPV accept versus reject rules. If the NPV is positive, we would accept the project because we make money. If it's negative, we reject the project because we lose money. And if it's zero, we accept it because we do not lose money. But that, of course, is only from an academic standpoint. So in summary then, the NPV is an investment appraisal tool that helps us determine whether or not we should invest in a given project. It focuses on the cash flows instead of profit and is calculated by PV minus I, where PV is the present value of future cash flows and I is the initial investment that we're putting in today. And of course, we accept projects that yield positive NPVs because we'll make money, and we reject projects that yield a negative NPV because we'd lose money. So what you've got here is the mechanical rule as well as the logic. The mechanical rule is that we accept all projects that yield a positive NPV and reject those that yield a negative NPV. And the logic behind that is that we accept projects that yield a positive NPV because we make money, and we reject projects that yield negative NPVs because investing in them would mean we'd lose money. And to avoid that, we simply reject the project. Okay, so that's the end of this video. Have a go at the quiz, and I will see you in the next lecture.